Hey, welcome everyone. I'm Ted Erhart. At the onset of the pandemic in 2020, I put out my first educational video, which is something I'd been wanting to do. Finally had an opportunity to do it because obviously at the beginning of the shutdown, we weren't meeting with clients and so on. And what's in hindsight, 18 months later, roughly, it's interesting that the very first video, which was pretty rough cut, I tried to answer this question: what does it mean when the Federal Reserve buys bonds? Well, that's been my most viewed video by a long shot. In fact, maybe more than all the others combined. So it tells me it's obviously a question that's on people's minds. I've really improved my hardware and software, hopefully my delivery a little bit, so I thought this would be a good opportunity to revisit this question because clearly it's on people's minds. And I'd also like to do a follow-up answering the related question: what does it mean when the Fed starts to taper its bond purchases? That's kind of been one of Wall Street's obsessions here in 2021. So let's get started with that. What does it mean when the Federal Reserve buys bonds? Well, if we go back to March of 2020, the Western world seemed to realize all at the same time that this pandemic was going to create massive economic damage, and things kind of went haywire in the financial markets. In the United States, stocks ultimately sold off by nearly 35% in about 5 weeks' time, and we also saw a lot of rockiness in the fixed income or the bond markets where borrowing rates are set. Now, during this period, on March 16th, you can see the Wall Street Journal headline there. The Federal Reserve came out and announced that it was going to be buying $500 billion of Treasury securities and another, on top of that, $200 billion of mortgage-backed securities. Well, I want to try to answer the question, what does this mean? I guess it's two questions. And why does the Fed actually do this? And there's multiple reasons, but I want to kind of focus on the core one as it relates to financial panics. So to answer this question, you really have to understand how a bank works, at least at the most basic level. So let's say, for instance, you wanted to start a bank. What would that look like? Well, you'd have to come up with some of your own capital, and let's just say you brought $100,000 to the table. What you would do next is you'd go out and raise deposits. So we'll say $900,000 in this case. Now, the way a bank makes money is it takes those deposits and ultimately invests them or loans them out to businesses and consumers alike. And of course, the bank makes a profit by charging more interest on its loan portfolio or earning more interest on its investments than it pays depositors. So let's just say, for instance, rates are obviously low, but if the bank was paying 1% on its deposits and earning on average 4% on its investment/loan portfolio, let's say they're earning 4, well, the difference is 3. That's a 3% spread, and that's how a bank earns a profit. Now, the other thing to understand about banks is at any given time, a bank only holds a fractional amount of its deposits in liquid cash or reserves. Now, you can see quickly how this can be a problem if either A, all the depositors show up at the same time to take their cash out, or B, the value of these assets goes down and all of a sudden the bank finds itself in a position where its liabilities, i.e. its deposits, exceeds the amount of assets it has on its balance sheet to make good on those. Now, this is kind of a chicken and egg type thing. What comes first? Well, frequently during times of panics, when stock prices are going down or the value of all assets are going down at the same time, that itself can create panic or fear, and it can create depositors to show up on the banks. And this can create a negative feedback loop because what happens, again, when more depositors show up than what the bank has in the vault to make good on those deposits? Well, in normal conditions, the bank could sell part of its investment portfolio in the open market to create the cash and make good on its deposits. But if everyone is showing up at the same time at every bank in the United States, that means every bank in the U.S. is also trying to liquidate their portfolio to create cash. Now, when you read the history books about the bank failures and bank runs in the 19th century, what I just described is exactly what would happen. Is in some region of the country, there'd be fear, whether it was real or imagined. And when everybody shows up to draw their cash out and the banks all have to dump their investment portfolios at the same time, well, prices go down. And then you can literally create a domino effect of bank failures. To solve this problem, in the United States, we set up the Federal Reserve System in 1913. And one of the Fed's principal duties is to serve as the so-called buyer or lender of last resort. So when these panics, these periods of extreme stress occur, the Federal Reserve can step in, because you have to remember, the Federal Reserve controls the money supply, which means they literally have the ability to create money out of thin air. You know, it's not a big deal if one bank finds itself under stress and has to, dump its investment portfolio. One bank's no big deal. But again, if every bank in the United States is trying to do it at the same time, there's simply no one with the buying power to step up and basically make up for that lack of demand. And again, that's why we set up the Federal Reserve. The Fed can literally create $1 trillion out of thin air and use that $1 trillion to buy all these bonds that banks are trying to unload at the same time to make good on their deposits. So in periods of extreme economic stress, again, like March of 2020, like 2008, this is why the Federal Reserve will step in with these bond purchases. It's to stomp out these panics and inject liquidity in the system to keep everything from freezing up and basically creating a domino effect, which could result in a collapse of the entire financial system. Now, the other thing the Federal Reserve can do is continue its bond purchases beyond the initial panic in an effort to suppress interest rates. Now, that's really a topic for another video, because it kind of just requires the explaining of the mechanics of that, how Fed purchases actually bring rates down. If you're interested in that, drop me a comment. Let me know if you'd like me to discuss that. It'd probably be a pretty brief video. But anyway, if you want to get a hold of me, if you want to find me, I'm out here on YouTube trying to get this channel up and rocking. Also trying to figure out the whole Twitter thing. So follow me on Twitter. I think I'm in the low single digits right now. I'm just working on that. You can also reach out via email. Here's our company website. But as usual, thanks for following along. This is an interesting topic. Like I said, I'll try to follow it up with a discussion about Fed tapering. So thanks so much. We'll see you next time.